Welcome to This Explainer. Today, we are absolutely dismantling the whole fantasy of passive income and rebuilding it with a realistic step-by-step blueprint. We're pulling directly from the insights of top financial creators to show you exactly how wealth is actually accumulated instead of how the internet pretends it is. So let's just dive right in. Is making money in your sleep actually a real thing? Or is it just internet clickbait designed to sell you a dream? You know the drill. You see it all the time. Promises that if you just buy one thing, click a few buttons, and set up a system, you'll literally never have to work again. But we really need to separate the marketing hype from the actual mechanics. The internet absolutely loves to sell this dream of sitting at a cafe on a Tuesday, casually refreshing an app to watch thousands of dollars roll in while pretending to be retired at 26. But the reality, as creators like Steve from Call to Leap and the host of Smart Money Stories point out, your first taste of passive income is going to happen when you're doing something completely ordinary. Think doing laundry or pumping gas. It's not a glamorous shortcut. It is a wildly unimpressive reality at first. Maybe you get a notification for just 43 cents or a couple of dollars. But listen, it requires years of consistency before the magic of compounding really kicks in. That first tiny payment, that isn't freedom. That's just proof that the system actually works.
So here is the exact blueprint we are going to use today. First, active income. Second, high-yield vehicles. Third, dividend ETFs. Fourth, digital assets. And finally, some advanced strategies.
All right, starting with step one, active income first. This is your foundation. I know. It's not what anyone wants to hear when we're talking about passive income, but the secret actually starts with grinding out active income. As the creator James Invests perfectly puts it, wealth is built in the gap between what you earn and what you keep. You simply cannot save your way to wealth. You have to increase your skills to grow your paycheck and then firmly control your lifestyle to widen that gap that fuels your investments. Because if your lifestyle grows at the exact same speed as your income, you're going to stay stuck forever. The fastest way to stronger passive income later is absolutely stronger active income right now. It gives you the breathing room to actually save and invest. Moving on to step two, high-yield vehicles. Let's call this the easy win. Okay, this is literally the easiest adjustment you can make right now, today. Leaving your savings in a traditional transactional checking account earning a fraction of a percent is a massive mistake. Think about it. A standard big bank might give you a 0.07% annual interest rate. Meanwhile, institutions like Capital One, Ally, and Betterment are offering around 3.8% to 4.0%. A transactional account is just a cash flow tool to receive your salary and pay your bills. It is a terrible, terrible place to store your long-term money. So, moving your cash to one of these high-yield accounts does two things. Yes, it builds that crucial $10,000 to $30,000 emergency fund, but more importantly, it acts as a friction tool. Imagine you've got $300 left over at the end of the month. If it's just sitting there in your checking account, it feels spendable, right? You'll accidentally blow $40 on a late night in and out double-double. But if you move it to a completely separate high-yield account, you create a boundary between you and your own impulse spending. And as a bonus, you're earning real interest that actually adds up over time.
All right, step three, dividend ETFs. This is the medium win.
Once you've got that emergency fund locked in, we graduate to the stock market. Now, a lot of beginners think investing is like finding a needle in a haystack, trying to pick the one secret stock, like the next NVIDIA, that will instantly change their lives. But the pros? They suggest buying broad funds, like the popular dividend-focused ETF SCHD. This completely reduces your risk because you're owning tiny pieces of hundreds of companies all at once. If one company has a terrible year, the others balance it out. These funds not only grow in value over time, but they pass a portion of those companies' actual profits straight back to you as regular cash dividends. Just a quick warning though, never blindly chase a red flag high yield. A massive 10% yield is usually a warning sign of a struggling business, not a free gift. Let's put some real math to this. Say you're an urban planner, saving $700 a month and investing it consistently. In the beginning, it is painfully slow. In year one, you might only see about $320 a year in dividends. That is definitely not changing your life. But fast forward to year 5, and that portfolio could be generating $2,000 a year. Over a decade, that growth eventually accelerates in a major way. The most important thing happening here isn't just the math, though. It fundamentally changes your identity from a consumer into an owner. Next up, step 4, digital assets. The digital hustle. Now we're getting into totally different territory, leveraging the internet to completely separate your time from your money. Creator Greg Godfried highlights Amazon KDP, or Kindle Direct Publishing, as one of the fastest ways to start. Now, you aren't writing massive, sweeping novels here. You're creating simple files for things like lined journals or, even better, low-competition products like word search puzzle books. You do the work exactly once to create the file and upload it. From then on, every single time someone buys it, Amazon prints it, ships it, and handles all the customer service, while you just collect a royalty. It is the literal definition of doing the work up front to get paid infinitely down the line. And honestly, Amazon KDP is just the tip of the iceberg. The real magic happens when you start stacking these digital assets to build robust systems. You could use Amazon Merch on Demand to sell t-shirt designs. You could create digital downloads on Etsy, like a beautifully formatted budgeting spreadsheet that saves someone hours of frustration. Or what about starting a YouTube channel focused on educational content that actually pays significantly more in AdSense than purely entertainment-focused videos? Whether it's selling an online course on Skillshare or doing affiliate marketing through video, these are digital assets that can keep paying you for a decade after you hit publish.
Finally, we arrive at step 5, advanced strategies, layering your income.
So for those of you who have patiently built up a serious asset base over the years, we reach an advanced strategy called covered calls. Essentially, you trade away a tiny bit of potential upside growth in your portfolio in exchange for immediate guaranteed cash flow. You are basically saying to the market, hey, I agree to sell my shares at this higher price next month, and you have to pay me cash right now just for making that promise. Whether your shares eventually get sold or not, that upfront premium cash is yours to keep forever. Here's the breakdown of how this actually scales up. To pull this off, you need to own at least 100 shares of a specific asset. Let's say you're holding a major S&P 500 fund like SPY, which trades around $690 a share. That means you need roughly $69,000 invested just to start. Yeah, it takes time to build that base. But once you do, you can offer to sell those shares at, say, $720 30 days from now. The moment you make that trade, you collect a $250 premium upfront. It's an unbelievably powerful way to add an entirely new layer of income on top of assets you already own. When you put it all together after, say, 10 years of pretty unglamorous, boring discipline, you get the real picture of passive income. It is definitely not a magic button. It is a multi-layered financial machine. You've got your high-yield savings generating $60 to $80 a month acting as your rock-solid safety net. Your brokerage account with dividend ETFs is dropping up to $1,000 every quarter. And your covered calls are generating hundreds of dollars a month in premiums. Now, none of these individual streams will make you instantly rich, but stacked together, they change your life entirely.
So are you willing to embrace the boring reality today to actually own your freedom tomorrow? Because passive income isn't magic. It is just the long-term, slow accumulation of active skills, digital assets, and compound interest. The only real question left is this: which of these structured systems are you going to start building right now? Will you take 5 minutes to open that high-yield account today, or will you just keep waiting for a shortcut that doesn't exist? Really think about it. Thanks for joining me on this explainer, and I'll see you next time.